So hello everybody. Welcome to H&T's annual results presentation for the financial year ended December 2024. I'm acutely aware it's a very busy time for businesses reporting, so I'm very grateful that so many people have made the time to join us this morning. I'm with Di Giddy, the CFO. What I'm going to do is give a brief overview on what's going on within our business and a bit of a strategic update. Di will then do the meat of the presentation, talking through the numbers and the segmentals, and then I'll come back and talk a little bit about what we're up to and where we go from here. The store in the picture there is our shop in Bath Street, Glasgow. Some of you may not know us or may not know us well. I'd like to think that if you haven't visited one of our stores, that store probably looks a bit different from some of the preconceptions of what a pawnbroking shop is like. One of our key strategic planks is to invest in our store estate in order to make it more modern, more light and airy, and a bit more welcoming for people to come in and join us. So hopefully, if you don't get a chance to visit one of our stores, hopefully you will try and find the time to do so soon. So for those that don't know pawnbroking, I'm going to spend a couple of minutes just talking about what it is. It's probably the oldest still available source of finance. Some people say it goes back 3,000 years. It's certainly been used in a number of historical moments. It was quite common, for example, for the Spanish royal family to pledge the crown jewels to fund various things, including Christopher Columbus's journey to the States. The symbol, the three gold balls that you'll see outside most pawnbroking shops, is from the 14th century, banking family the Medicis in Italy. There was in the past a close link between pawnbroking and banking, and in many parts of the world, Pacific Rim and indeed still in Italy, those links are still there. It is only really in the UK where the perception of pawnbroking is, as indeed is in the UK, of being old-fashioned, a bit stuffy. Dickensian is a word I've heard used. Outside of the UK, that really doesn't apply. Until the middle of the 20th century, pawnbroking shops were common on towns, cities, on high streets. There's a lot less of those shops now, largely, I think, because for the last two generations, if you've needed to borrow a small sum over a short term, you've had lots of options. Those options are much more restricted than was the case, and therefore there is, in our opinion, a systemic growth opportunity for pawnbroking and as the market leader for H&T in particular. We did some research recently and it turned out lots of people didn't realize that pawnbroking was actually a regulated service. It is very much a regulated service, regulated by the FCA. In terms of H&T, we've been around a long time. Originally formed in the late 1800s, Mr. Harvey and Mr. Thompson incorporated the business in 1897. That's the H and the T. Now we are the largest pawnbroker in the UK. We do other things as well. We are a top six, or at least the last time the league table was published, a top six jewelry retailer. We are growing a financial currency business for those people that need and still want to use foreign currency when they go on holiday, and we'll talk about that later. But overwhelmingly, we are a pawnbroker operating from 285 stores. So for those that don't know us or don't know the industry, I'm going to talk a little bit about what pawnbroking actually is. And I think it can be summed up in three words: simple, inclusive, and transparent. Simple because, unlike other forms of lending, we lend directly against the asset that is pledged, that's the word, pledged as collateral for the loan. So a customer comes in with an item against which we are prepared to lend. We do not lend in H&T against electronics, mobile phones, etc. 98% of our lending is against gold, jewelry, watches, precious metals, diamonds, overwhelmingly gold. So the customer will bring in the item. The guys in the store will then verify that it is real and value it. They will then offer the customer how much they are prepared to lend, or if the customer wants to sell the item, how much they're prepared to pay to buy it. The customer then borrows usually what they need, but sometimes the maximum that we're prepared to offer. The big difference between our business and other forms of lending is we have no recourse to the borrower ever under any circumstances whatsoever. Our sole recourse is to the asset against which we have lent in the event that the customer is unable or chooses not to repay the loan. It's very inclusive. in that we help customers who are largely excluded from mainstream financial services, whether they want to borrow a small sum over a short term or whether they're a small business owner that needs to help fund working capital for their business. We enable them to access the credit that they need. They are often excluded from mainstream financial services. It's also highly transparent. At H&T, our pawnbroking loans are simple daily interest. So if you use it for 38 days, you pay for 38 days. There is no compounding. If you use it for 110 days, you pay for 110 days. No compound interest, no fees, simple daily interest. And the customer knows they have no liability to H&T beyond the value of the asset that they have pledged. Now, very briefly on the right-hand side, what we're trying to depict with this wheel is that our customer base is slightly more female than male. But if you start at 25 and work up through the various age brackets, we've got 10 years each here, but if you work up from 25, our customer base is almost equally spread between those age groups. And there is a perception that pawnbroking is used far more by older people. Actually, it's not the case. It's much more widely spread age-wise and roughly equally spread between male and female customers. So moving on to talk a little bit about H&T. As I've said, we are a trusted consumer brand operating through 285 stores, the largest UK pawnbroker. We do other things. We are a top 6 jewellery retailer. We do foreign currency. We do Western Union. We do other things. But overwhelmingly, we're a pawnbroker. And our strategy is all around growing the pawnbroking business. The reason for that is because it drives everything here. It drives our revenues. It supports our retail business. 3/4 of what we sell is pre-owned. The vast majority of that is sourced through our pawnbroking business. We will continue to invest in the store estate, new and existing. We will continue to invest in technology, which we'll talk about later. And as Di will explain in a while, our overriding aim is to increase operational leverage and optimize the allocation of our capital. So just to finish from me, the key themes for today. In 2024, we did reinforce our position as the UK's largest pawnbroker with record lending volumes and record levels of new customers borrowing from us for the first time. The pledge book grew ahead of expectations, albeit the majority of that growth was in the last 4 months of the year. And Di will explain some of the implications of that when she joins the presentation shortly. Our strategy, as I've said, is to grow and broaden the core pawnbroking business. It is the foundation of future growth, and we've put additional funding facilities in place to facilitate that. We will continue to invest in the store estate. We'll talk about that. We want to continue to grow the attractiveness of our retail offering. I was really pleased with the level of growth we saw in retail last year. We want that to continue. And finally, as previously advised, we will be changing our financial year end from December to September in order to even up the current slight disparity between the two halves of the year in terms of our earnings, and Di will explain more about that shortly. And today we have published comparatives for the year to September 2024 to assist investors with the transition. So that's it for me for now. I'm going to hand over to Di to talk through the financials and the segmentals.
Thank you, Chris, and welcome everyone. I'm going to take us through the next couple of slides in 3 parts. Firstly, financial results, followed by our deep dive on our products, and then I'll close with the change in our financial year end. So let's start with our financial headline summaries. So the main themes I want to pull out from this slide today is starting with our income from operations. We can see that our income has grown by 14% for the year, while our costs have grown by 12%. Also important to note is our finance costs have increased, and this is with our increased use of borrowings that we had during the year. So this will translate to profit before tax that we've earned of £29.1 million, and that is up 10% on last year. Chris has mentioned it earlier, but corporation tax rates increased in 2023. So 2024 is the first full year in which we have this new tax. So following from that, earnings per share, which is an after-tax measure, has increased by 5% this year, while our return on equity, also an after-tax measure, fell slightly to 12.2%. Our final dividend is 11p, and taking our full year dividend to 18p, which is a 6% increase on last year's dividend. If we then turn our attention to the graph on the right-hand side of the page, which shows our operating income versus our operating expense distribution. It's a graph we refer to with the jaws. What we can see is that our operating income has achieved a CAGR, so compound annual growth rate since 2001, of 16%, while we have a lower CAGR for our expenses of 11%. So this reinforces our continued positive jaws, and that we continuously look to drive our revenue to grow at a faster rate than our costs do. What you can also see in this graph, particularly on the top line, is the heavy weightings we have for our operating income in the second half of the financial year. And this is as we have both of our peak retail and FX trading periods in the second half of a financial year. I think it's also important at this point to remind ourselves that in spring of this year, we saw a number of our customers redeeming their pawnbroking loans, a pattern that emerged for the first time last year. However, what we saw this year was that those redemptions were higher and they continued for longer than anticipated. So what do we mean by redemptions? So redemptions is when a customer chooses to repay their loan and collect their pledge item, which, when all other things are equal, result in a smaller capital value and a smaller pledge book, and therefore earning less interest during that period. So for the combination of those reasons, we are changing our financial year end in 2025 to September, and I will pick that up in more detail later. If we now turn our attention to our income statement, we can see that our gross profits has increased by 22%, with our core pawnbroking product contributing 64% of this growth. We saw sustained demand for our pawnbroking product in the second half of this year, along with improving margins from both retail and gold purchase. And we will go into more details on this later in the presentation when we look at the segmental product results. The next line on the income statement is the impairment charge of £33 million, and this includes two parts. Firstly, it's the uncollected interest on the pledge loans that we have forfeited of £29 million. Now, this uncollected interest is that part of interest that we have previously recognized in the revenue line for those loans that have since forfeited. So when an item forfeits, we have to show the reversal of this interest on the separate line. And this charge naturally increases with the growth in the underlying pledge book. What then happens is this impairment of interest charge is recovered through the disposition of the pledge item, so either through a pawnbroking scrap or a retailing activities. And this is why we are now including pawnbroking scrap in our pawnbroking income. And in the future, we will look to also bring the retail portion of income from these disposed assets into pawnbroking income. The second part of the movements in this expense is the movement in your IFRS 9 provision, and this has increased by £4.6 million. And this has increased for two reasons. Firstly, the growth in the pledge book, because the stronger the growth in the book, the higher the provision is required. And secondly, we increased our lending interest rates during the year. So this necessitated that we reviewed the assumptions in our IFRS 9 model, and that required further provisions to be raised. If we move on to costs, cost control is key for us. Our costs have grown by 12% for the year, and employee costs make up almost 60% of our cost base. Our employee costs have seen an increase of 9% this year, and that is led by the increase in national living wage. Financing costs have also grown, and this is with the greater use of funding facilities at a time when interest rates have stayed higher for longer. And the combination of all of the above have resulted in our profit before tax of £29.1 million, growing by 10% on the previous year. I briefly touched on corporation tax earlier. We saw that the tax rate increased to 25% in April 2023. So what we have seen is an increase in our effective tax rate increased to 24%, whereas previously it was 20%. So with the increase in this tax charge, profit after tax has grown by 5% to £22 million, and our earnings per share growth has followed the same trajectory, growing by 5% to 50.9p per share, and our dividends have increased by 6%, growing to 18p per share, and that is in line with our dividend policy, and as we look to strike the balance between generating shareholder returns and investing in future growth. We now turn our attention to our balance sheet. Our balance sheet remains strong. Working capital is our largest asset, and this consists predominantly of our pledge book. And our pledge book had a carrying value of £158 million at the end of December. That carrying value is made up of, firstly, the capital value lent, which is £127 million, plus accrued interest of £42 million, and then reduced by the IFRS 9 provision of £11 million. I touched on the IFRS 9 provision movement a little earlier, but it increased by £4.6 million. And this is driven by, firstly, the growth in the pledge book, and secondly, the review of our input assumptions for our model. So the provision at the end of the year was just under £11 million at 10.5. This increased level of provisioning has allowed us to increase the provision coverage ratio on our pledge book to 6% versus 4%, which is what we had in the prior year. Our fixed assets grew with the continued investments in our stores, both our new, existing, as well as in our IT technology platform. We have seen our inventory balances remain unchanged at £41 million, and we've ended the year with a net debt position of £54 million, which leads us to look at the cash flow. If we look at the cash flow in more detail, we have increased our operating cash inflow to £47 million this year, and we have increased our borrowings by £26 million. We have used this additional funding to grow our business through growing our pledge book, which is in working capital, investing in our CapEx, in our stores and our IT. We, of course, bought Maxcroft at the beginning of the year and then paying tax, interest and dividends. We have closed the year with a net debt position of £54 million. The group has available funding facilities of a total of £85 million, and we had used £69 million of that at the end of the year. We still believe our gearing levels remain modest given the size of the balance sheet, and at the end of February, we had £14 million of funding headroom available. There are more details regarding our funding stack, the interest rates and covenants at the end of the presentation. I'm now going to move our attention to our products and their contribution to our profits. On this slide, we see that our core products are pawnbroking, retail and FX, and their contribution is in that order. Pawnbroking contributes almost 2/3 of our profits. And from this year, we've included the pawnbroking scrap income into the pawnbroking segment as we've previously referenced. And retail consists of sales of both new and pre-owned jewelry, watches, coins, and gold bars. So let's start with pawnbroking, our core product. Our income has increased by 5% to £78 million. And this now includes pawnbroking scrap profits of £10 million. We saw that our borrowing demand by our individuals and business owners continued to gather momentum during the year, especially at a time when the supply of your small sum short-term lending is reduced. Our capital value of our pledge book grew 26% to £127 million. And this was as we saw our gross lending increase by 14%. And we saw that lending to our new customers was around 12%. The underlying metrics of our pledge book, being our LTVs, our duration and redemption rates, have remained fairly consistent during the year. What we did see was that our median loan values and the mean loan values increased, and that was as our customers chose to borrow slightly more, and the fact that the proportion of larger loans in our pledge book increased. So what do we mean by larger loans? We define those as loans that are greater than £5,000. And these are the loans that tend to be used for business purposes, as Chris touched on earlier. They represent a growing proportion of our book, so they are now 18% of our pledge book. And we have achieved this growth as we deploy the learnings that we have on larger loan lending from Maxcroft across our wider business. I think it's important to spend a little bit more time on the risk-adjusted yield that we earn on our pledge book. Our yield is calculated using the average capital value of our pledge book, as it more appropriately reflects the distribution of the growth in the pledge book during the year, and the income includes the pawnbroking scrap income. So this year, the yield on our pledge book was 71% compared to the yield restated on the same basis for last year of 78%. That yield has been impacted this year for three main reasons. The first, we've seen very strong growth in our pledge book in Q4. Now, when you have growth that is weighted towards the end of the year, you have little contribution to revenue for the year, as you've got much younger vintages in the book. However, the balance sheet reflects that full capital growth, so you see slightly lower yields. The second reason, the increase in IFRS 9 provisions, so that's two parts. One, as we've seen a growth in the book, but secondly, the increase in the lending interest rates that we made during the year required a review of those IFRS 9 assumptions, and based on that review, the model required us to increase those provisions. And the last reason is the higher redemptions we saw from our customers in the spring of 2024 as they chose to repay their loans. So when they chose to repay and redeem those loans, they reduced the capital value and on the pledge book, and so we have reduced the yield earned during that period. If we now move on to retail sales for the year increased by 27% to £62 million, with the margins recovering to 31% from 30% last year. And actually, in this case, the margin was even slightly more than that, but unfortunately, I lost on the roundings this year, so it's rounded down rather than rounding up. But we've achieved record levels of online lending this year, and we have contributed 22% of our total sales from our online activities. We saw strong growth in the periods leading up to Diwali and Christmas. And both of those are both in Q4 of our current reporting cycle. We also saw that our customers had particularly strong demand for new and pre-owned gold bars and coins, and this was encouraged by the high gold price that we saw during last year. Now, our customers continue to prefer lower price items, so they are choosing to buy those items that are new versus pre-owned. And the reason why is because newer items are generally lower price points. So the contribution to our sales from new items made up 25% of our total sales value. Allowing us to understand our customer trend allows us to optimize the in-store jewelry offering that we have. So we are currently running trials in some of our stores to sell new jewelry primarily. And the reason for this is because new jewelry is much easier to merchandise, it's easier to sell online, and it requires less processing time. And the last point on retail, we've implemented price increases during the year. We have also seen less watch price volatility. So overall, our retail margins improvements is expected to continue into 2025. Foreign currency profits grew by 11% to £7 million. And we achieved this as we saw our transaction volumes increase by 10% during the year when there was a strong demand for overseas travel. What we did see within the currency transactions, though, is that currency sales exceeded our expectations, while purchase transactions, and this is across the wider market, were lower than expected during the summer, but they did recover in the end and towards Q4. Our customers choose to take physical cash, and we believe that will continue into the foreseeable future, despite the increasing focus that we do see on cashless payments. The last point on foreign currency is that the reason we offer this product is because it is often represents the very first transaction that we have with a new customer to H&T, and the growth that we've achieved in this product is due to the increased focus during the year, as well as learnings that we have from Maxcross, and we've deployed those learnings across our wider store estate. If we look at gold purchase, our profit grew by 72% to £15 million, and we saw that our transaction volumes were broadly flat, while the margins were significantly higher at 27%, and this was supported by the gold price that we saw during the year. What we did during the year for our product was we made a very conscious decision not to increase the offered pricing for gold purchase, and we focused on margin on this product over the volumes. The last product segment we have is our other services. Now, we offer the other services in our stores to bring footfall to our stores. The key one to pull out is the money transfer service we offer. We are Western Union's largest customer by volume of transactions, and this brings over 500,000 customers to our stores every year. And moving on to the last slide for me today, which is our change in our financial year end. We have decided to change our year end to September This will allow us to more evenly spread our financial performance across the two halves. The first year for this change will be this year, which is September 2025, reporting a 9-month period. And when we do that reporting, you will also include your comparative results for the 12 months to September 25. There will be no interim reporting for 2025. However, we will issue a trading update, and that will cover the first 6 months of calendar year 25. To help support with this transition, we have today published a comparative 12-month results to September 24, and also our dividend cycle will follow this change, and we've included details as well in the results we published today. Thank you very much, and at this point, I'd like to hand back to Chris.
Thanks, Di. I'm now going to talk a bit about the strategy, the focus, and some of the things we are up with and up to in H&T. If I look at our stores, it's really pleasing to see that we've got good growth in revenue per store, pledge book per store. We've managed to absorb higher running costs per store, but we've delivered that growth in revenues and the pledge book with the same level of FTEs per store. We're working hard to make the business more efficient. That is supported to a degree by technology, which I will talk about in a moment. But strong growth in 2024, 8 new stores added with 1 closure, increasing new customer numbers, and focus on that operational efficiency. Now, on the subject of stores and the refresh program, this is very much about making them more modern to look at and more modern and welcoming for people to come into. This is Stockport. It looked kind of okay before, but it was dated. Hopefully you'll agree that the picture on the right, it's a bit more modern. It's modern colours. The merchandising in the 2 counters at the front is a bit better, and it's a bit lighter and airier. And our aim, because we also did the outside of this building, is to just make it a more modern and a more welcoming place for people to come, as opposed to a bit old-fashioned. Doesn't cost us very much a store on average. The reason for that is we have brought a lot of the work in-house. So we now have our own team of people who go out and do these refreshes, which enables us to keep the cost down significantly. So in terms of where our stores are, as you can see from the map, we operate across the UK, but not national coverage. There are still parts of the country where we are under or unrepresented in terms of our stores, and there are opportunities still to grow the geographic footprint. We added 8 stores in 2024. You can see them listed here, including, and the photo at the bottom right, Eastern Avenue, which is the new internal name for the Maxcroft store that we acquired in February of last year. Now, one of the questions I often get asked is, where is the growth coming from? Because the growth in the pledge book has been significant since 2020. And that is what drives our revenues and our earnings and our retail business. So the bars on the top chart on this slide show the growth in the pledge book and where it's coming from. What you can see is it was broadly flat from 2013 to 18. For those that don't know us, in 2019, we acquired 70 stores from what were at the time 2 national coverage businesses, along with the full pledge books of those 2 businesses. Some of those went into our core estate. And then came COVID. Since 2020, you can see consistent, solid growth from the dark bars being our core stores. That's those that we've had for some years. Some would define them as mature. I think what it shows is actually there is still significant growth potential from our core store estate. But you'll also see the top 2 bars. Those are the acquired stores and the stores that have been added since 2020. Every year, they contribute more and a greater proportion of the growth. So if you look at the bars in the 3 blocks in the second chart at the bottom, the left-hand block is the core estate, those stores that we've had for some time. And you can see there that the growth has been pretty consistent in year to year since COVID. And if you go back to 2019, the average pledge book per store was about £200,000. It's now £500,000. The right-hand 2 blocks, the first one is the 2019 acquisitions. You can see that we have delivered, again, consistent growth. Those stores were mostly already mature, already offering the service when we acquired them. What we've managed to do is make them focus more on pawnbroking. The interesting thing is that the average pledge book in those stores is now around about £300,000 relative to the average of £200,000, which was in our core estate when we acquired those stores. So we've grown them to and above the average that existed at the time. If you look at the block on the right, those are the stores that have been mainly opened and to a less extent added since 2020. We opened the first one at the back end of 2020. The chart's a bit flattered in 2024 by Maxcroft, but we didn't want to exclude that. What you can see again is those stores steadily and consistently growing the size of their pledge book. The angle of incidence is slightly lower. The reason for that is those stores were not as established, and in the case of the new ones, not established at all at the point at which they opened. But again, the average pledge book on those stores, even if you exclude Maxcroft, is now around about £200,000, and that is the same as the core estate was at the time of the 70 store acquisition in 2019. The purpose of this slide is simply to say we expect the core estate to continue to grow. We expect the new stores and those that were acquired to continue to grow, on the assumption that we can grow those stores to reach today's average pledge book per store, accepting that we expect them to grow too. But if we grow it to today's average pledge book per store, that's a substantial growth, a substantial increase in revenues, and, in our opinion, an embedded value factor within the business. So moving on to retail, three parts to retail: pre-owned, new, and online. Pre-owned is about 3/4 of what we sell, as Guy explained earlier, overwhelmingly sourced through our pawnbroking operations. So without pawnbroking, we wouldn't have most of those items to sell. And at some point, we may need to think about the geography within the P&L, as we've done this year with pawnbroking scrap. Very important part of our business, very valued by our customers, because pre-owned is very much the thing in recent years, better from a sustainability point of view and a carbon footprint point of view, but also better value for money generally. New is a growing part of the business. It's about 1/4 of what we sell. By and large, our new items are lower price points. And what we've seen in the last 18 months to 2 years is customers migrating and wanting lower price points. We're very focused on that. The nature of our business means we can be pretty nimble and respond quickly to customer needs. Online has really grown since COVID. It's now a really important part of our business, 22% of retail sales, and it remains the case that about half of them by value are viewed in store before the customer makes the purchase decision. Really, really important that we're investing in that. So moving on to technology, which is another plank of our strategy. We have an in-house system which we call Evo, has been developed over the last few years, is increasingly being rolled out across the wider business. It's already fully embedded in our store estate. Probably 3 years to go with that program. What it's done is it's made us more efficient, more effective in our stores, and transformed the customer journey. It is one of the reasons that we've been able to deliver the growth that we have with broadly the same number of people working in our stores. We're also working hard on our online presence. The screenshots on the right-hand side of this chart were taken at the beginning of the week this week. So it's kind of how our websites look today. The one in the center is the main retail website. You can see some of the watch brands that we specialize in there. The one on the right is the click and collect travel money landing page, which hopefully in both cases you will agree is a bit more modern and a bit more up to date than some people might expect from a pawnbroker. And the bottom one is simply we're very proud of our Trustpilot scores. So I'm now going to focus a little bit on the outlook and the investment case for H&T going forwards. We believe there is a strong macroeconomic reason why we envisage future growth for this group across its portfolio of products. Look at the pledge book. We think there will continue to be strong and growing demand, both from people who need to borrow a small sum over a short term, but also people that need to use our services to fund their business. It's worth just reiterating at this point, we don't lend to businesses. We don't lend against business assets. This is private individuals pledging personal assets, exactly the same assets that we always lend against, mainly gold, jewelry, watches, but pledging those assets in order to raise money for working capital in their business, whether they are shopkeepers, often people who work in the building trade, etc. Exactly the same business model, exactly the same assets, but larger loans and the money being used for slightly different purposes. As far as retail is concerned, we think that the whole societal shift towards the attractiveness of pre-owned will continue. And our pre-owned items offer very good value for money. Growing demand for new jewellery, particularly for people looking for lower price points. We think that by expanding the range that we offer and by remaining nimble as customers' preferences change, that this will remain a growth area for us. As I said, I was very pleased with the growth last year. We want that to continue. Foreign currency, people say to me, surely it's all going on to cards. Not entirely the case, actually. There is still a role for cash. In many parts of the world, as Di found out when she was on holiday recently, you can't pay for a taxi with a card. They will only take cash. I think the role of cash will continue for the foreseeable future. We are growing our share of that market, and we still see further growth to come from foreign currency. As regards the cost base, we have talked quite a bit today, predominantly a fixed cost base. Our job is to drive footfall to the stores. Our people then work their magic and develop the relationship with that customer. Our job is to grow the jaws, as Di showed on her first slide earlier in this presentation. Make sure revenue grows more quickly than costs. Moving on to the investment case, I think there's a strong investment case for investing in H&T. We all do here. We are the clear market leader. We've been around for a long time, the largest pawnbroker and a top 6 jewellery retailer with other income streams alongside. There is a structural growth opportunity. Target audience is growing, both for small sum credit and for business owners, and for the type of jewellery we offer for sale, particularly pre-owned. And there's an opportunity to keep growing the store footprint. So there is a structural growth opportunity, we believe. Our job is to deliver strong returns through the cycle. We have and will retain a target to meet mid-teens post-tax ROE over the cycle. I have to say that the increase in tax rates last year didn't help us with that journey, but we remain committed to the target and to delivering it over time. We want to be a responsible member of the communities in which we operate. We are a regulated business. We've found out recently a lot of people don't realise that, so we'll be putting some effort into raising the profile of the fact that this is a regulated business and a responsible citizen within the communities in which we operate. And we believe passionately that our business is sustainable over the longer term. Pledge collateral is precious metal, watches and jewellery, overwhelmingly, always within our control. No recourse to the borrower at any time, ever. That makes it very different from other forms of consumer credit. We have a strong control and operating environment, prudent underwriting policies, and strong customer advocacy that we guard very, very dearly. So for these reasons, I think there is a strong investment case for investing in H&T, and that's kind of all I wanted to say in this section. I'm now very happy to bring it to a close and open up for any questions anybody may wish to ask. And thank you for listening so far.